Hey, welcome back to the channel. My name is Jesse, and today we're going to be checking out Coca-Cola. All right, we're going to jump straight into the income statement, and we're going to look at the historical information for Coca-Cola. We can see over the last 10 years, we've kind of had this decrease in revenue and started increasing just over the last probably 5 years or so. EPS diluted, everything's been staying fairly consistent. Per share basis, we've had a little bit of buybacks, but not a ton. With the balance sheet, we can see cash might be a little bit low right now. Total current assets versus total current liabilities is almost the same. All right amount of cash in hand. Total assets and liabilities over time, it's kind of remained fairly consistent. Goodwill and intangibles, fairly consistent as well. So pretty much steady Eddie with this one, just kind of going along with it. Free cash flow statements over the last 10 years, we can see, has a little bit of cyclicality. Looks like on a quarterly basis, looks like that's Q1 on a yearly is typically pretty low compared to the rest of the year. We've seen that every single year. So some type of normalized event going on in Q1 for the cash flow. We look at depreciation, amortization, everything kind of pretty much consistent. Most of their cash historically has kind of gone towards debt repayment, decent amount of dividends paid, a little bit of common stock repurchase, but a lot of it has been towards debt repayment. Going over the ratios and metrics. So we can see that even as their revenue was kind of declining during this time over here, their margins starting increasing over the last like 5 years or so. So we've seen some slight improvements in margins from let's say about 2012 to 2017 versus 2018 to 2022. They've had some improvements on their bottom line margins. So even though they've been bringing in a little bit less revenue, their bottom line profits have stayed pretty healthy because of the margin increase. Per share metrics, fairly stable over the last 10 years. Saw a little bit of a dip in 2017 and a rebound recently. So earnings on a per share basis have been pretty consistent. Valuation metrics, you can see kind of valuation wise, it's been fairly consistent as well. So not a ton of like multiple expansion or anything like that, or contraction. See historical dividend payouts. They've been a steady dividend payout and have increased that dividend steadily over time. EV, enterprise value versus market cap. So they normally keep on a little bit debt compared to their cash balance, and that's probably why we see a lot of debt repayment in their free cash flows, because they're constantly kind of cycling through that debt. Revenue and gross profit growth. Revenue growth is declining fairly consistently. So I kind of want to look into this more in a more in-depth review sometime of why they had this tail off in revenue. And then we saw gross profit and revenue growth over the last couple of years. So dilution buybacks, they have been diluting the last 2 years. They were buying back for a while, and then they moved to dilution. We have EPS growth, which just cut like one off, but hasn't been anything insane. Dividend growth has been about 2%. Yeah, so they're growing the dividend about 2 to 4 or 5% per year. We'll look at the estimates for the next year. Analyst estimates show revenue growth over the next year, along with EBITDA growth, EBIT growth, and net income growth. So bottom line growth and top line growth, analysts are estimating. So see a couple sales, nothing too crazy, a humongous gift of shares right here. Let's go over to the kind of valuation chart that I have here. We can kind of see the historical bottom line yields, kind of the multiple that the market has been giving to this stock, Coca-Cola, over the last 10 years. And it's varied anywhere from maybe like around 6% down to 3% one time, 4% right now. So it's interesting, the last 8 months, 9 months, what we've been going through with the macro environment is a lot of consumer staple stocks have been favored, because think of something like Coca-Cola, it can easily pass on cost increases to the consumer fairly easily by doing, like raising the price of a Coke by 20 cents or so, and you pass on your inflation costs. So a lot of these consumer staple, solid staple plays have typically will do better in a environment where rates are starting to raise, and we're going into like a recessionary period. They tend to outperform by not going down as much, typically. So we can check that out on the yearly chart too. But so anywhere from 5% down to like 3%, moderated maybe at 4%. If we look at the 5-year average, the yield spread has been 2.24. The net yield spread has been 0.97, and the free cash flow yield spread has been 1.53. So for this, the 5-year bottom line growth, it says 26%, but that's kind of influenced by this kind of bad data here from the free cash flow growth based off the periods that I'm selecting over the last 5 years, because it goes from 6 to 1 to 6, so it's going off that low point. If we look at EBIT and free cash flow, actually, sorry, that was net income, but free cash flow and EBIT were right around 13 to 15%. So really, we've seen about 13 to 15% growth over the last 5 years for most bottom line metrics that we can really go off of. I have an assumption that, maybe we're going to get a best case scenario of like 11.5, 12% over the next 5 years, but that's just my assumption. If we go through the targets that I have, is a base CAGR of 10%, a margin of safety of 2.5%. It is paying a 2.9% dividend yield, so most of the capital return to shareholders is through a dividend. They're not doing really buybacks at this point in time, but I'd have to dig more into the company and do more of a qualitative analysis to figure out what they're guiding in the future, what they're going to be doing as far as buybacks, if they're planning any buybacks. But for this pretty surface level numbers evaluation, we can just go off of this and then update in the future. So in my scenarios, we've got very bearish to very bullish cases. On the 10-year treasury, or the risk-free rate, I'm going very bearish 4.87 to very bullish 1.99. Bottom line growth for Coca-Cola over the next 5 years, projecting very bearish 6% to very bullish 11.5%, which you could make an argument that this might only grow with inflation, depending on if they can't get margin expansion. But it's also a safer play because they should be able to at least grow with inflation over potentially a high inflationary time. Arguments could be made probably either way. EBIT yield spread, very bearish 2.94 to very bullish 2.24. Very bearish net yield spread 2.36 to very bullish 0.97. Free cash flow yield spread 2.49 to very bullish 1.53, with a bottom line fair value yield average kind of from the very bearish standpoint would be 7.46 to 3.57 from very bearish to very bullish. So, and a lot of this is going to be decided between the risk-free rate and what the Fed does with rates going forward. If we're sticking into a high rate environment, then we're going to get into more of these very bearish scenarios, or this bearish and very bearish scenario as far as the risk-free rate. But with all of that, we can see that the very bearish price target for 2026 year end would be $43. The bearish price target would be $55. The base case would be $70. The bullish case would be $90. And the very bullish case would be $118. But that does not include any type of dividends paid. So that 2.9% dividend, as long as they continue paying that out, that doesn't include any of that. Or these numbers do not include any of the dividend paid. So really, if we are targeting 12.5% and we have a 2.92% dividend, it's really a CAGR of around 15%, which is probably pretty high for something that is this big, this established, and like this kind of, like a lot of the growth is probably tapped out for them. Depending on the investor, you might want to, use a lower base CAGR of 5 or 7%, depending on what your target is, what your kind of threshold is for your investment. But based on this target rate of 12.5, that's the numbers we get. Based on that scenarios, the very bullish buy point would be $67. We're within that right now. The bullish buy point would be $51. The base case buy point would be $40. The bearish buy point would be $31. And the very bearish buy point would be around $24 approximately on these numbers. So we are kind of getting there. We're in the very bullish price point right now. Honestly, for consumer staples, we'll probably have to go into a different type of cycle for these to be kind of get into a better buy zone. If money starts flowing back in towards higher risk, higher growth assets and out of staples, then we get some downward pressure that might push these into those base and bearish cases. All right, so if we look at the 5-year chart, we can see we had a section of time where it did get below $40, got down to around 38 or so. then came back up. So it's going to be very hard to get this type of a asset returning 12.5% is probably a little bit unrealistic. So, maybe you'd want to use 5% or something like that, which would be about 10% overall. But I want a large margin of safety. I'm kind of targeting a higher percentage. So, whatever. Most likely won't be able to get it then. But if we look over the last 5 years, kind of see this fluctuation around $40 to $50 pretty consistently, which would take us right between the base case and the bullish case. So there is a chance we get down the base case if we had a rotation out of kind of consumer staples back into growth. I don't know. We'll see. We'll see what type of catalyst that could happen to take it there. If it would be fundamental, macro. I don't know. We look at the max. You can see that had a huge bull run from kind of the 88 to 98 area. 1988 to 98, and then we just stagnated for how many years? Like a long time. It's crazy. Man. So 98 to 2018, that's almost 20 years before it regained those highs. That's insane. So it'd be very interesting to see the I guess evaluation metrics back here and what happened over that period of time. So yeah, we'll see. See what happens going forward if we get some of that chop and consolidation downward. Year to date, like I said, consumer staples usually do better in a bad macro environment, especially with the rising inflation, because they have more pricing power to pass inflation costs off. So year to date, this is actually up on the year, miraculously, up 0.4%. That's what I got for you guys. Hope you enjoyed it. Have a great day. Please like and subscribe if you enjoyed the content, and we'll catch you later.